All right, well, thanks everyone for joining. I see some familiar faces and some new faces, so it's great to have you guys here. I'm Ryan, this is Mike. We're from Volcan Capital. Just a quick blurb on Nextera. We're looking to syndicate. We look for deals in our backyard here, Bucks County, Montgomery County, and we're also looking in Huntsville, Alabama. So we have a site visit there at the end of next month. So if anyone's interested in investing in some larger multifamily deals or out of state, come talk to us afterwards and we'll see if we're a good fit. But our guest speaker tonight is Ryan Daubert from Lehigh Partners. So why don't you just start by introducing yourself? Tell us where you're from, what you do.
Ryan Daubert, my company is Lehigh Partners. So we're an independent insurance agency based out of Bethlehem, Pennsylvania. Also where I live in Bethlehem, Pennsylvania. Specialize in working with real estate investors. Probably about 80% of our book of business is investors, everything from single family homes, multi-hundred unit complexes, and everything in between.
Yeah, so I guess from a property or insurance, what's your role in investment property?
Yeah, so I'll usually step in as early in the process as we can. So even when investors are just looking at properties and trying to gauge insurance costs, we kind of can come in as a resource and kind of guide them based on what we see in the area. And then we run that process all the way through closing. Or if it's an investor already with their properties, we'll get involved with them. We don't necessarily need to see what you have going on. We kind of run everything from scratch based off of what we recommend and what we've seen other investors be successful with, and kind of go from there. So everything from consulting on different policy types, structuring risks, remarketing existing policies, and everything in between.
Okay, so if I'm looking to invest in a property, maybe I'm doing a market visit, right? Should I be out and look out for someone from insurance, or should I kind of wait until I'm ready to put down a buy-in?
Yeah, so it's never too early to reach out. I mean, I think the biggest pet peeve for myself and my staff is like, hey Ryan, by the way, I bought a 5-unit yesterday. I forgot to get insurance, which happens multiple times every single week. So I always say the sooner you get your agent involved, the better. Now, if you're just kind of window shopping, just looking for general information about an area, we might not necessarily want to take it out to all the markets that we have, but we can give you a pretty close idea of what you're looking at. We run bindable quotes. We're usually wait until you have something under agreement. At that point, then we'll take it out to market. Depending on the property, we could take it out to if it's like a 3 or 4, we can run it both in a commercial and personalized form. We might send it to 100 different places. So some of those have manual underwriting processes, so it can take a little while. And obviously a little labor intensive. So
If I'm looking at a bunch of properties and looking to LOIs, I want to have a good idea of the numbers going in. How much time should I allot for coming to you and saying, hey, I need a quote on this property?
So we can do it same day. If you needed us to, we could, but unfortunately, we're usually pushing somebody out who might have reached out a little bit before you had in that scenario. But we can turn stuff quick if we need to. But generally, the more time you give us, the better. I would say, if we submitted something for quotes tomorrow, usually 2 or 3 business days, we'll have 90% put back. So there might be a few stragglers depending on the carrier, but we'll have a pretty good idea. Usually like 2-3 days, something like that.
Kind of want to say, a larger multifamily. Do you guys go out to the property to see it's checked?
So thankfully, with the advent of newer technology, including Google Maps, we don't travel to a lot of properties. We can just be a lot more efficient using online resources. So, either like listing photos, information from the client, Google Maps, depending on when it was the last time the Street View car drove by. And that gives us a pretty good high-level overview of the property that we need. So, generally, after policy's bound, most carriers will send somebody out to, walk around the property, make sure the roof's still on, things like that. But generally speaking, we don't actually travel out to properties.
A lot of the commercial, if we're looking at some commercial buildings around here, it'll be mixed use, apartments on top and business below. How does that affect the insurance? I know it has some implications with lenders.
Yeah, for sure. So anything that's mixed use, even if it's a commercial business like a salon below a apartment, that has to go in a commercial property form. So anything generally 1 to 4 apartment units can typically we would do it on personal lines form called dwelling fire policy. Obviously covers a lot more than just fire, but it's technically a personalized product. Anything next, even if it's much smaller and it has that commercial exposure, it's always going to be a commercial form policy. So usually something called BOP, business owner's policy. It's probably where about 90% of it goes. But yeah, that mixed usage definitely changes the policy form, coverages, rates for sure.
Hold on a second. Can it mess it up a little bit? I mean, say it's like a nice 8-unit, multifamily on top, and then you got like this old pizza shop at the bottom. Like, how do you factor that in?
Yeah, so a lot of carriers will have restrictions, and most of them are specifically around commercial cooking. So it's a human life safety issue for them that, if there's a restaurant below, there's a fire, and there's 10 apartments above, it can create an issue. So it certainly limits the market, whereas, just ballpark numbers, if you're going to send it out to 50 companies, maybe only 15 would look at that exposure. Pricing wise, something like that, you usually expect a little more premium than if it was just pure apartments or even like a clerical business. So really that commercial cooking is probably the hardest one. Or dynamite manufacturing, if you got that. I don't know what to do with
If it's commercial building and it's like a triple net lease and they're responsible for their insurance, how does that tie in with yours?
Yeah, so for us, nothing from our side. Really just as long as the policy's getting paid. So, that's all the insurance companies care about. So yeah, if the owner's structuring it within their leases, at the end of the day, as long as it's flowing from the owner's account, to the carriers, there's not really too much coordination on our side.
I guess once the deal's closed, we kind of done. Put this way, my mortgage, my house, I haven't talked to my insurance company since I bought that. So are you done after that, or is it stay in touch?
So you shouldn't necessarily be done. So you always want to make sure your stuff's getting looked at, especially where the market is these days. In my career, this is the craziest insurance market I've lived through. With where inflation is, and then also the crazy fires that happen down in California and the crazy storms in Florida have absolutely nothing to do directly with Pennsylvania risk, but it impacts the reinsurance costs in the back end, which is insurance for insurance companies, impacting rates here. So it's kind of like a perfect storm of just craziness. So certainly in this market, you want to make sure your stuff's getting looked at. So we automatically remarket every year, doing 60 days out and 30 days out for our clients. But you don't just really want to set it and forget it because rates are really dynamic. And as far as communication, so we kind of set preferences, or a lot of agencies do this too. Just however you want your communication preference, email, text, whatever medium you prefer.
Yeah, we'll definitely talk about mistakes investors make. What is something that you turn business away, or say, hey, I'm not taking you on as a client?
It's not a really turning away. We just might not have markets for it. So, Florida, for instance, the Florida insurance market's pretty much on the verge of collapse. I think the average homeowner's premium in Florida for a house where I live is $7,500, which is insane. We never really targeted Florida, but if we had a client up here, maybe having a second home, they asked us, they wanted everything with us. We had some pretty decent markets, but now it's challenging. It's tough to even get some of the surplus lines markets like Lloyd's of London to look at stuff down in Florida. California's quickly behind there. Texas is a little challenging too. So, especially with Florida, I'll always just say, try to run something, but really your best option is finding another local independent agency down there who might have some smaller mutual companies that are still writing business, but generally all the national companies like your Travelers, Nationwide, they're not really writing anything in Florida, California.
So maybe another mistake for investors, other than just taking the cheapest rate, which is probably most common. What are some other mistakes they make with picking up a plan?
Yeah. So the biggest thing we see is the settlement terms, which can be kind of tricky. So there's really three main ways that property insurance settles. So the Rolls Royce, what we always recommend is replacement cost. It's a construction estimate, what it would cost to rebuild that structure brand new. Written in blood, basically, in your contract, the carrier is obligated to rebuild that home exactly like it stands today, brand new. The one we always say avoid like the plague is actual cash value, which is market value minus depreciation. And then you're also putting it in the hands of an adjuster who works for the insurance company. And insurance companies are profit-driven entities too. So that adjuster can come out and they start whatever's on your policy. It almost doesn't matter. They look at the market value, what the property is, and then they say, well, the roof was 15 years old, so we're going to take off 10 grand for that. And original plumbing here, so another 20 grand off for that. What can happen is certainly you're not gonna have enough to rebuild. You might not have enough to buy something comparable. And then also the nightmare scenario is that if you have a loan on the property and if someone else not get ACV policy past the lender, you might not have enough to pay back your loan. So that's where people really get in trouble. Now there's last couple of years we've been seeing it more prevalent than it has in the past. Carriers are changing some of the policy language where instead of replacement costs, they call it similar replacement costs or functional replacement costs. And what that does, it again puts it back into a human adjuster at the insurance company, and they're only obligated to rebuild your house as functionally similar to what was there. So like if you had nice crown molding, granite countertops, Formica, crown molding's gone because it's the same square footage, functionally the same. So I don't want to pick on any company, but we see it a lot with State Farm, where like big bold letters up top, you'll see 100% replacement costs. You read down half a page and like real tiny print, you see replacement costs on the dwelling, functional replacement costs. So it's in my opinion misleading, and it's something that we see people get tripped up on. But the biggest thing is just replacement cost coverage, where carriers obligated to written in their contract. So that's the biggest thing. Secondly, I would say the importance of your structure. So like 10 years ago, we used to see a lot of carriers really push, if you have 10 different rental properties, put them all in the same policy. There's a couple problems with that. Number one, if you have a bad claim and the carrier, non-renews the coverage, now you're stuck shopping 10 properties all to non-renew in your history. The second thing is if you have a bad liability claim and you exhaust your liability limit, you could essentially be leaving your entire portfolio completely exposed for liability claims for the rest of the year. So we try to stay away from those. So really just diversifying your risk is probably the most important thing.
Kind of off of your first part, if you buy an investment property and you do a lot of value add to it, and you put in some of the crown molding, granite countertops, after you're done all that, should you get another policy, or should you just refinance and go through that route? What's the best way to protect?
So if you're buying something that's vacant and it's under renovation, so we'll do a builder's risk type policy. And then when it's occupied, a more traditional policy. But if you have something that's, maybe it's like a 5-unit, 10 occupied, depends on the carrier a little bit, but like, between tenants, you're upgrading the units, you can typically stay on that same policy. If you're, just doing, some minor, not any kind of crazy repairs. But then part of that in that replacement cost calculation is it's probably a conversation you would have with your agent when you're done. If you added value to that property and essentially made it, spent more money on construction, you want to make sure your construction estimate on your insurance is a little bit higher. So just a quick number.
Yeah, it seems like kind of everyone's getting into real estate. It's not a two-part question, but usually people are influenced to get into real estate. So I know you have your own investments, we can definitely talk about it, but what kind of got you into the insurance side of it, and then also what drove you to get into your own investments?
So I don't think anyone, like when they're 12 years old, is like, you know what, I want to be an insurance guy. Like, I think like every financial movie too, like makes fun of insurance people too. So it's not like a glamorous career or anything like that. How I started out of college, I was offered ADP, the payroll company. I was offered 3 jobs. One was payroll sales, one was workers' compensation sales, the other was group benefits. Being a broke college student who still lived at home, workers' comp paid the most, so that's where I went. So I worked there for about a year, saw how much relatively dollar amount I was making for the company, how little of that I was bringing home, and then I saw really just a gap that service was basically, hey, call 1-800 number at the carrier. That's like what we're directed to do. So it's like, man, if I could just sell like 1 month of what I do here, like I'll make more than what I was doing there. I certainly know I can do a better job of servicing somebody. I started from scratch. Most insurance agencies are multi-generational businesses, so hope my kids do something different, but at least they have this thing to fall back on. But I started from scratch, so I mean, there's challenges in everything you do, but I mean, there's definitely some benefits too. Is that we kind of designed our practice and how I thought would best fit our customers, and so I think there's benefits of not really having a multi-generational thing too. So
While you're growing your practice, where do you spend the most time on that to facilitate the growth?
Yeah, so the biggest growth for us is client referrals. I mean, we've tried, like for like marketing standpoint, like my strategy is like always try something once and see if it works, see if it doesn't. And really for us, it always has been. It's just strategic referral partners and referral sources. So, you know, we try to do a great job for you, and you know, and hopefully you tell your friends about us. So, insurance, like at least for our agency, it's incredibly referral based. So that's where we spend a lot of time, is making sure, you know, we're doing right by our partners.
What mistakes do you think that you've made, either while you're growing in your business and in your practice, or from real estate investing, that others might be able to learn from you?
Real estate is thinking that it was going to be a passive investment. So it was certainly not the case. That was a rude awakening like 2 days after I bought my first rental property, and I'm chasing down like $25 late fees. And so that was my biggest mistake. I thought about selling those properties like a week after I bought them. But like my next call after that was a property management company. So, you know, I put a lot of my time into my insurance business, obviously, and so you know, it has to be my focus. So that was the biggest mistake I made, is assuming that it was going to be easy. As an insurance agency, I mean, I don't think, I mean, everything that we've done like kind of led us to where we are today. So like, there's nothing I could really look back on and say I regret. You know, with how we built the company, you know, maybe like hiring somebody sooner. I got some pretty late nights before I decided I could trust somebody else with you know, my baby. But you know, since that point, you know, I just, you know, never really look back and regret anything.
How big is your team now?
15.
Well, we like to transition kind of into the kind of a mindset aspect of it, because everything in real estate is mindset. So a couple of rapid fire questions we like to go through is, what real estate investment technology is like essential to your day-to-day?
So the biggest thing I think is critical for me is having a property management company that has really detailed reporting. You know, I can't put a lot of my bandwidth to actively managing my portfolio. So I need to put the tools in place that can help facilitate that. So the biggest thing for me is like really having that close relationship with the property manager, has documents on everything they spend, so I can kind of track it back.
For you, what is the number one thing that facilitates growth?
So, I mean, honestly, on the real estate side, I think it's things like this. You know, even like the last, like I'm under agreement on a 5-unit now, and you know, I use Embassy Bank for a lot of my stuff, and they're great lender, very conservative. They wouldn't rent off or pro forma rents, they wouldn't loan off of pro forma rents. And it was just a conversation I had with one of my clients, and he's like, call this guy, and then they got me in touch with People's First, and you know, like a lot better terms. I honestly might not have bought this 5-unit if you know, if I didn't get the terms I was looking for. So I honestly think like networking and just like relying on the people that you interact with, and you know, they're kind of in the same vein, is critical.
And what's your favorite educational book or podcast? What do you?
YouTube, yeah, big YouTube guy. So anything I'm looking to do, and thankfully I don't work on a lot of my own properties anymore. There's a couple exceptions there, but you know, anything I was looking to fix, or you know, even the first time, like, what is a cap rate? Like, I don't know this math. Like, you know, just like watching videos. Sometimes you gotta go through a couple to find the good ones, but you know, really, I think YouTube is a great resource, you know, for finding, you know, stuff that you might not have any clue on. So that's probably that's my first go-to. That's it.
You got to have some clients that have a handful of units and some that have a couple hundred units.
Yep.
What separates the top performers from the rest?
I mean, I think it's a couple things. I mean, I think number one is that networking component, and making sure you can find the capital structure deals. And I think it's honestly just an effort thing too. I mean, I think real estate I mean, the guy who said it's a passive investment should be shot. I mean, I just don't think that's true at all. So I mean, just the additional effort to like really like bird dog deals, and you know, learn from people who might have a bigger knowledge base in a certain area than you might. I think that's you know, that's probably the biggest factor.
What about the daily habit that you have that contributes to your success?
Waking up early, so that's the biggest thing. Yeah, so I'm usually up at like 5:30. So I shouldn't say this in public, but I'm usually in the office by like 6:45, 6:30, 6:45. But and why I say I shouldn't tell anybody that is that's like peaceful. My email's not going nuts. You know, my phone's not going crazy. I don't have 3 employees complaining about something, and you know, vendors and people stopping by. So I get more done in that like first 3-hour day than I would say most people do before they even start work. So I think that's probably the biggest thing is at least helped me was just kind of getting those extra couple hours of the day.
What about how can people get in touch with you?
Yeah, so I did forget every single one of my business cards, but so just lehighpartners.com. I'm sure you guys have my contact information too. But yeah, there's contact us one right there. If anyone wants my number, I'll give it to you as well. So
Anything that we might be forgetting to ask that you have been asked numerous times that might have some value?
great question, but I don't think there's. I mean, you kind of touched on some of the critical things as far as like structuring coverage. I guess maybe the only thing is you know, certainly as like you grow, you don't necessarily want the same coverage you had when you bought your first unit when you bought your 100. So it's just working with your advisors to figure out, you know, maybe what lines or endorsements you might be able to self-insure and throttle back on to make you know, your premiums run a little bit more efficiently without compromising coverage. So really just having conversations with whoever your advisors are, you know, trying to make things just run a little smoothly, more smoothly. So, other than that, I can't think of anything. Awesome.
Ryan, thank you so much. We're gonna kind of wrap up like we do with the post networking, so kind of get you guys involved too. But all we're asking from you today is just what was your purpose for attending, and then kind of where you're at in your real estate journey so far. So Jeff, we'll have you start.
Purpose, you know, is to connect with like-minded people that are in multi-unit investing, and I'm a property manager. So I have a new company. We're 3 years old, and that's, you know, why I'm here. And I really wanted to learn. I wanted to connect with you in regards to a question I asked prior about protections in the leases, commercial leases versus residential. What, you know, I would want you to take a look at our leases and say maybe change this language, do this, because that benefits many different owners.
For sure.
So I think it's very pertinent for me to make sure the insurance end of things is buttoned up for our clients.
What was the question?
This is your
What am I here for?
Yeah, where you're at.
To hear this great speaker, to meet all the rest of these guys besides those two and this one. Because I already know them. So learn.
Yeah, my name is Bibi. I'm an investor. I have a few single family under my belt. I would like to venture out and multi-unit family, and you know, just want to reach and connect people in general.
Ed, Gary, just carpenter trying to get in, stay away from people that can, and you know, learn what I can and network.
You're not doing a great job because you're in the same place tonight. So.
He invited me to be in a partnership, so he's not very smart.
Brian Pager. I've never met these guys.
Yeah.
A couple of condos in Charlotte, North Carolina. Recently bought a vacation rental. Definitely interested in multifamily, but it seems like that market's sort of crazy right now with everything else. But and then we were talking about potentially like a residential assisted living facility or personal care. So trying to learn more about that as well.
Do you have any experience with that like personal care home or assisted living?
Yeah, we do a couple. It's not something that I would say we like specialize in. But yeah, I mean, they come along from time to time.
We're going to need your phone number so we can call you at 6:30 a.m.
Give me a fake one at the office.
Let him sit down and get his coffee. 6:45.
We would love to reach out and maybe chat with you about what you have.
Hi, I'm Diana. I invest in small multifamily. I have a duplex like 2 streets down, so it's like in my area. So this is fantastic. Looking to go and just scale. You know, I don't know if I want to be like a landlord of like duplexes and triplexes for an indefinite amount of time. I think it just makes more sense to go and start looking at something bigger and to meet all these other fabulous folks.
Hi guys, I'm Cole. I'm just here I'm in multifamily syndication stuff as well. Just here to network, meet everybody, support, see this guy. So
You can talk about your 12 unit. Quick update.
Quick update, we just closed a 12 unit in North Carolina, which is super exciting. So excited for that. I'll leave it at that.
Okay.
Which part of North Carolina?
It's in right outside Winston-Salem.
Oh.
So Kernersville, yeah.
Well, we're, as I said, we're from NextEra. We're thrilled to keep hosting these events. We're going to stick to the second Tuesday every month. We really enjoy doing them. We know that people, like you said, always want to come out, learn from our speakers, but also networking is extremely important. So that's why we try to leave the last hour or so open to chat a little bit, exchange some contact info. We want to continue to advertise and market through the Facebook group. So if you're able to join the Facebook group or join our Facebook page as well, we'd greatly appreciate it. That's where we send most of our updates out to. And then also, we're always looking if anyone wants to open to sponsoring these as well. NextEra and us, we're hosting tonight's and hosted the last couple. But if there's anyone that's looking to sponsor the events, we're certainly open to that idea. Other than that, thank you so much for coming, and we will see you guys the second week of March.
Can we ask some insurance questions?
Absolutely, yeah.
All right, so you mentioned 10 units you would separate in some way. You can do that, 10 separate policies?
If it's 10 individual properties, so if it's just one building with 10 units. Yeah, so, yeah. So I mean, even if they were, well, like if you have 5 unit here, 10 unit here, 2 unit over there, I would do 3 separate policies for that structure.
And price-wise, does that change anything?
Yeah, I mean, it's so not every carrier likes every risk. So like we've seen, I think there's a little bit over 3,000 like actuarial factors that go into calculating an insurance premium. Don't ask me all of them. I know the high level ones, but we've seen it where a carrier will cut their rating territory, and a house on this side of the street is best with X carrier, and on the other side of the street is best with Y carrier. So to really run your portfolio as efficiently as possible, again, not every carrier likes every risk. So you certainly for the diversification, but then also from like the value standpoint, always makes sense to use different carriers. Give the carrier that really wants it, is going to offer you the best terms, give them the business versus like forcing it down one company's throat.
So I just wasn't sure I'm understanding. I'm sorry, I'm jumping somebody else's questions. So potentially have 10 different units, 10 different policies for 10 different units, and potentially be cheaper, even if they're all like in Philadelphia or something like that.
Mm-hmm. Yep.
And if they end up with 4 different carriers, they're not going to complain that there's 3 different policies for the same.
No, and if anything, like your accountant's going to love you more because they're not trying to figure out, which policy, which premium goes to which building and what part of it. Because like the general liability is all a blend. So
a total loss claim of 1 doesn't affect the other.
Yep. Yeah, everything else runs unimpacted by it. So that's the biggest thing too. Is if you do get a non-renewal, that's an application question that you have. And there's a lot of carriers out there that doesn't matter. They don't care why it non-renewed. If it non-renewed claims, or whatever. If that answer is yes, they won't even take the business. So it really limits your market. So from a diversification standpoint, and you're not also sharing that singular liability limit across multiple assets. So yeah, always we recommend doing separate policies for each individual building or structure.
So, yeah, you really recommend against the blanket policy? Well, we gotta talk, because I have a blanket policy.
What about like umbrella? Would you recommend doing individuals that like umbrella?
So that's a great question. So from a liability standpoint, from a landlord, so especially like just speaking specifically like multifamilies, like the cost to go from $1 million liability to $2 million, we're gonna charge you like $50 a year. So it tells you how likely they think that they're gonna have to pay out that additional $1 million. Like, just do $1 million divided by 50. I'm terrible at mental math, but that's how many policies you have to sell a break even. We're just selling one and having one claim. So like slip and falls, Philadelphia you'll see probably the highest slip and fall payouts. Outside of those more like bigger cities, like slip and falls are really low ticket items, and the carriers know that. So like the umbrella question, on the multifamily, if you have 1 million, 2 million, you're fine. Smaller stuff, all day long, 300,000, 500,000. The true purpose of what I think an umbrella policy or product should be used for is really sitting on top of personal, home, and auto. There's a thing that not a lot of people think about. They think, okay, well, I'm going to put everything in an LLC and different LLCs for different properties. But they don't really think about if you blow through a red light, and you're way home, and God forbid, seriously injure or kill somebody, you get sued personally. it's not a primary residence. Those are just business assets that you're the sole shareholder of. And I call it backdoor liability. You can do something personally that impacts your rental portfolio. So the biggest thing with umbrella products, I always just recommend at least over just your home and auto. I'm not really too concerned about them sitting on top of a commercial policy that already has $1 million in coverage.
I got more questions unless somebody else does. Please. I mean, do you know how to read because your favorite book was YouTube?
Yeah, I saw this. So I got these questions preloaded to me too. So I was like, oh man,
You had time to think about it.
I got 2 little kids that run around. I got a family and a growing business. So I do know how to read. I don't do a lot of it. But,
And now you
my
want to be partners with me, right? So hypothetically, you buy a house. It's move-in rented, so you don't have to do anything to it. And hypothetically, it has knob and tube, and you put a claim in later. Are you still covered?
So I didn't hear the second part. The first.
It has knob and tube, but you didn't do any work to it, so you didn't.
It hasn't been moved into.
It was nobody's living in it, but you rent it, and then you find out later it has knob and tube. Probably assumed it did because it was from 1910 in Philadelphia.
So I mean, it depends. I mean, it's like some carriers are okay if you have if you're going to do like a quick just painting it and fixing them a little bit. Some carriers might be okay going straight to an occupied policy if there's an expectation in 30 days will be rented. Some carriers don't use that as like a hard and fast rule. But I mean, generally just policy types. I mean, to cover that exposure, there's specific products for it, like a builder's risk product, which is your liability component and also your property coverage. So I mean, just really matching and being honest with your agent and trying to match that exposure. Just so
But if you know there's knob and tube, it may not be covered at all.
So specifically with knob and tube, there's some carriers that are okay with writing it, a lot aren't. So some, and then some, if it's like pigtail, they might be okay with it. So it's just a conversation you have to have. It would be a misrepresentation if you know there's knob and tube, you sign your name on an application that says no knob and tube, you have an issue. I mean, the carriers were well within their rights to get off that policy. They need to know what they're on the hook for essentially. So properties with knob and tube, it's not uninsurable. It just limits the market. So it's a conversation you just have to have. Because I mean, it's a nightmare for everyone involved. If you have a policy that you've been paying for, and you go to cash in your chips, the teller closes the window. So it's just having that conversation.
And you cover Philadelphia?
We can, yeah. Mm-hmm.
Can you run home and get a business card for me?
We'll get you. So I'm like stuck in my car seat somewhere.
If you gave us your email tonight, you're gonna get so much.
I'll announce it to the group, but I'll give it in my card. Because my company has grandfathered me in, but it's not taking nothing to going forward. So.
Yeah. I mean, you're seeing just a real tightening in the overall market happening right now. Like those factors I said, but habitational risks like apartments. What we're all here doing is that's like the redheaded stepchild of the insurance world right now. So a lot of companies, like the bigger national carriers, have all really pulled back, or they only write stuff that was built after 1980, and then 2 weeks later get another email and we're writing it's built after 2000. And we live in Pennsylvania. I don't think there's not too much that's built after that time period. So it's just thankfully we have enough markets where we can kind of navigate the kind of boulders in the stream, if you will, for the time being, until what I say like the greed comes back into the market and carriers are starting to compete for business again, versus like trying to write less. So like Nationwide, for instance, we still do a pretty nice book with Nationwide. They had a really good habitational product. They stopped writing every single line of business back in March of 2023. So it'll almost be a full year we haven't been around a single auto, a home, or investment property with Nationwide. So it's just a crazy time. But yeah, it's just navigating the carrier market.
So when you say that non-renewal, like I've had quite a few owners have their policies like canceled.
Mm-hmm.
is that a non-renewal, or does it have to be for a claim, like a?
Yeah, so that, like, the application question is kind of this, it's usually has it been non-renewed or canceled within the, past, there's usually a time component there. And sometimes the carriers just want to know why. And if it's a small, like a more regional mutual company, maybe they're right 3 or 4 states, you're usually dealing with a human underwriter. So you can say, hey, well, it's just non-renewed because the carrier X in the market or something like that. They're usually okay with it. But like, bigger companies like Travelers, as soon as you check, it's just an algorithm looking at it. So as soon as you check yes, they don't care. They're not gonna write it. So it's, again, just navigating that kind of the marketplace.
Is there anything I can do to limit concern for owners?
As far as like,
And them as, investors too, like.
I mean, I would just encourage them to have to review their stuff. And it's challenging now because we're getting emails every, we have a number of carriers, so we certainly get a lot more emails, but with changing guidelines, as carriers are trying to figure out the market. I mean, there was I don't ever want to be in the position like the defendant insurance company. I work for my clients, not for the carriers, but there was I don't know the final 2023 numbers, but there was like a $38 billion underwriting loss through 3 quarters of 2023. So the carriers aren't making money. Nationwide told us they were like 136. So every $100 of premium they write, 136 goes out to claims and expenses. So it's just a turbulent time in the market. So I would say is keep an eye on your renewals. We've seen a lot of our book with Nationwide see some larger than what we would typically expect renewals come through, and then we're just remarketing and putting them somewhere else. So it's just making sure they're staying on top of it. And I don't know how involved you get in your practices, seeing what they're paying, and if it looks a little crazy, it might be. So just encourage them to take a look at it.
What would be required if back to the knob and tube stuff? What's required to offset that? Do you need a permit from the city or something from an electrician that the house was rewired? What would the insurance company?
Yeah, so I mean it's case by case. I mean it's going to be carrier dependent. There's some carriers that if you even start saying you get the K of knob and tube out, they already ran for the hills. So there's that, and then there's sometimes some carriers might be okay if it's pigtail. Some might be okay with an electrician's report that says, hey, everything's okay here. Some carriers might ask that it be completely removed before they, look at the regs. So there's not anything there's no one-size-fits-all answer for your question that you just need a permit or inspection or something. It's good. It's just going to be a conversation to have.
And most of them use the honesty method. If you say you took out the knob and tube, they'll cover it that way, but put a claim in later, there's not a tube.
Yeah, I mean, it's always you always have to be very careful with the applications. Make sure you're answering your best ability. I mean, truthfully, you have no idea there's a wire in there. I mean, you can certainly make the argument that I had no clue. Everything we saw was circuit breakers, and not fuses, and everything looked good. The wiring I could see. I don't think you really get too much pushback on that, but if there's knob and tube and 100% knob and tube, and you talk to a couple electricians,
and there's always circuit breakers.
Yeah,
I have 20 some houses and none of them have those glass turns.
Yeah, I mean we see the fuses up more in the rust belt a little bit more, and that's honestly maybe even easier than knob and tube, but yeah, it's different carriers are all have different guidelines, so it's just having those conversations.
What do you think the insurance market's going to shake out? It's going to stay like this?
I mean, I think it's like interest rates. I mean, the interest rates go up real fast, but they sure seem to go down pretty slow. So I think there's definitely a component of that in the insurance industry overall that, and granted, some of it is justified. I mean, rates and where inflation is now, building materials, obviously, labor's gone up. I know I certainly pay a lot more for human capital than we used to. So, I mean, there is a component that can be justified, but I think, the people will tell you, other agents will be like, 2024, it should start smoothing out. I think it's certainly in 2025, probably in 2026 before you can start kind of just to smooth it out a little bit. I say when the green comes back into the market, when carriers start to compete for business. But yeah, I think we're in another couple rocky years. It'll hopefully smooth it out.
Might be an odd question, but why don't the insurance companies go out to the properties? Is it almost because like they almost don't want to know some of the things?
No, it's certainly not that. So I mean, it's every time they do an inspection, it's like they got to send somebody physically out. Usually with like a drone and like park, gas, expenses, their workers' comp insurance, everything. So I don't know the exact numbers, but it's something like every property costs like $300 to send somebody out to inspect from the insurance carrier standpoint. So gone are the days as carriers try to run more lean to find profitability again, where they're spending that up front to send somebody out to review the property. So they'll usually wait till the business closes and they know there's like a pretty good chance, and they've done all their homework up front. But they'll kind of just do their final, make sure Google Maps looks accurate. But yeah, and from like an agency standpoint, 15, 20 years ago, a lot of people would go out to risk before they write them. But also geographically, they might have only written in one town too. So for us, we're in like 26 states or something like that. So like, I can't send somebody to like Massachusetts or North Carolina or something every time there's a risk. So generally, the carriers will just take care of the inspection after the closing.
Cool.
Thank you.
Thank you. Appreciate it.